to another episode on my channel. Today we're going to be doing a deep dive into one of my favorite dividend growth companies, American Express, or Amex for short. If you've been watching my channel for a while, you should be familiar with my investment portfolio tracking spreadsheet as shown here. This is where I list all the various companies that I have investments in and how they are performing. So without further ado, let's look at American Express. I have about 10.4 shares of American Express. Got it at a cost per share of $149. The market price as of close Friday was $157, which means I'm up about 5.53% or 85 US dollars. Makes up about almost 5% of my total portfolio. Now, American Express is in the payment processing sector, which is the same sector as another one of my holdings, Visa. So I made a full video on Visa and their business last week. So before watching this video on American Express, I encourage you to go back to last week's video and watch the video on Visa, as a lot of the concepts and ideas will make a lot more sense if you watch that video first before watching this video on American Express. And I'll leave the link to that video in the description below. So I'm going to lay out what we're going to be doing in this video. Essentially, we're going to be looking at the payment processing sector as an overview. And then we're going to be looking at American Express's business. We'll be looking at their financial statements. We'll be doing a trend analysis. We'll be looking at what you could have made as an average annual rate of return had you own American Express over a specific time period. And then we'll close out with some specific remarks and my investment thesis. So without further ado, let's go and dive right into the market overview. This is the market share held by each of these companies in the payment processing sector based on the US. Here we can see Visa is the dominant market player here with about 50% market share, followed up by MasterCard at about 23%, and American Express coming in at a close third at about almost 20%. So Visa and MasterCard have very, very similar business models, but American Express does not. It differs from Visa and MasterCard in a pretty significant way, which we will look at right now. So if you watched last week's video on Visa, you would have been familiar with this chart right here or diagram. But if you didn't, I'll quickly go over it, an example of a transaction, as it will provide valuable both to Visa and American Express's business overview. So here we have a consumer. So a consumer, we'll call him John. He spends $100 at a shoe store, which is the merchant. He wants to buy a pair of Nikes, let's say. So what happens is John swipes his Visa card. The money is collected from the issuing bank, the bank who issued him the Visa card. In this instance, let's call them TD Bank. And then the information and the money is flown through Visa's data processing network to the shoe store's acquiring bank, and then they deliver that money to the shoe store. Visa owns this process of relaying information, or as they call it, data processing, and the flow of money is shown here as well for your ease. This is an example of what we call a open network. Now, how Visa makes money is they get a percentage of each of these transactions. So for instance, let's say John spent that $100. He would go then and swipe his card, and what we will call the discount rate, which is usually about 2 to 2.5%, is a percentage that is split up between these parties. That is paid out of the merchant's pocket. So when John swipes his card for $100, the merchant doesn't end up getting $100. Let's say the discount rate is 2.5%. The merchant will end up getting $97.50 of that total $100 transaction. Now that discount rate, like we said, is at 2.5%. In Visa and MasterCard's business model, the way it works is the issuing bank, like we said, TD, because they're issuing the card and then they're also handling the debt risk that comes along with issuing this card, they get a larger percentage of that 2.5% transaction. So the percentage that they usually get can vary, but it's usually about 70% of that 2.5% transaction, which is roughly $1.75. So if the discount rate is 2.5%, which is equal to 2.5, dollars, $2.50. TD, as the issuing bank, would get about $1.75 of that $2.50 total from the transaction. Now, Visa, they get about 5% of this transaction. So 5% of this transaction being 5% of the $2.50, Visa would make anywhere from 12 to 13 cents from this transaction for delivering this information and the use of their payment processing network. The remaining 25% would go to the merchants network, such as Square or Global, the ones who actually conduct business on the merchant staff. They get about 25% of this transaction, which is anywhere from 62 cents to 63 cents. So that essentially is how Visa and similarly MasterCard's businesses are run. Now, what we really need to look at is the differentiation between Visa and MasterCard's business compared to American Express. So we're going to look at that by doing, a quick business overview and looking at this differentiated business model. I'm pulling this from the American Express Annual Report 2022. It's available on their website. So American Express is a globally integrated payments company providing customers with access to products, insights, experiences that enrich their lives and business success. They issue cards to both mid-sized companies, small businesses, large corporations, and consumers. They have various products, and they have customer referral programs, affiliate marketing, response advertising, etc. So what really interests me about this company is look how old they are. They were founded in 1850, and they were incorporated under the NYSE in the 1965, or the New York Corporation. Now, they have a very different business model, like I said. So in that example we used with Visa and MasterCard, we had an issuing bank who was TD, we had the network provider, which was Visa or MasterCard, we had a different acquiring bank for the merchant. As you can see here, Amex provides all of these services. So as a result, Amex is doing most of this work, as opposed to Visa and MasterCard, which provided the network for this transaction to occur. Amex is the issuer, the network, and the acquirer. Now, this is what you call a closed loop system, or their integrated payments platform. As Amex states here, they maintain direct relationships with both their card members as a card issuer and merchants as an acquirer, as they handle all key aspects of those relationships. These relationships create a closed loop in which they have direct access to information at both ends of the credit card transaction. This is amazing. They essentially control the whole transaction from the beginning to end. And as a result of this, they actually get a larger percentage of what we called the discount rate per transaction than Visa or MasterCard. As we previously stated, Visa or MasterCard get about 5% of the revenue associated with a transaction, whereas American Express gets a much larger portion because they are operating as all three of these parties, as opposed to just operating the network. Now, as we saw previously in our market share, we see that American Express has only about 20% of the total transaction volume market share. But we need to focus on things more than market share. Market share does not always mean that the company is in the best position or not running a profitable or futurely growing business. The market share is only one aspect. So when we go down, and we can see that, I've found this article here, American Express card members, they actually spend more, about 3 times as much as non-card members. So while Visa and MasterCard focus their business on generating a huge amount of transactions, they just focus on volume, and increasing volume. American Express has much lower volume, like we saw, at about 20% of the volume market share, but they have a higher card spend per consumer. So they are getting a larger percentage of a larger transaction per their consumer business, as opposed to MasterCard and Visa, which are getting a smaller percentage of a larger number of transactions. So if you are spending $100 as a Visa consumer, well, it's more than likely that as an American consumer or American Express consumer, you'd be spending 3 times as much using your American Express card. So you do not need to rely on the volume of transactions as much as the spend per transaction for American Express. Just to give you some more details on that, I externally looked at some research, and the average spend per transaction for an American Express consumer is about $170 compared to Visa or MasterCard, which is about $90 per transaction. Now, if we might as well look at their volume as well, because this isn't to say that their volume isn't increasing. So their volume is on a steady rate. As you can see, it does have declines when there was a great financial recession, COVID, as people were forced to stay inside and couldn't travel as much, which is one of American Express's largest consumer bases is travelers. So their volumes did decline, but right after COVID, they shot right back up as there was a big boom in the travel and entertainment business. So that's a brief overview on American Express. Now let's go look at their financial statements. So I've taken this from their latest Q1 2023 earnings. So here, as we can see, they have their Q1 2023, and we'll compare it to their Q4 2022. So their discount revenue, that is that percentage per transaction that we stated. It was down a little bit from the previous quarters, but as you can see, compared to the other prior quarters, it is steadily increasing over time. Net card fees. I didn't talk about this, but we definitely should. So this is revenue that they generate from issuing those cards. Like we said, they are also an issuer of cards. Now, they generate revenue by charging these annual fees for issuing cards to consumers and businesses. And as you can see, the annual fees here are pretty steep. So this speaks to another portion of American Express's business, which they are seen as almost a premium credit card company compared to Visa and MasterCard. And as a result, they can charge high annual fees, almost $700 for their platinum card, compared to their their Gold Rewards Express, which is $250, which is still very expensive. I have my Visa and my MasterCards for myself, which are, some of them are free. They don't charge me an annual fee, and some of them I pay, $100 or $120. Now, that is the revenue that they generate from their fee cards. And you might be wondering, why do people pay such a high annual fee? Well, like I said, one might be a status element to it. Having a platinum card, that is definitely an elite status item, or it could be perceived as an elite status item. Another item is their rewards bonuses. So their card members find extreme value in these rewards bonuses. As a new platinum card member, you can earn 80,000 welcome bonus points after you charge 7,500 in your net purchases in the first 3 months. That results to about $800 worth of travel points. So that $700 they spent on the first annual fee, that's more than covered with this $800 credit. And then their other big selling point for these cards is the amount of points that these consumers can generate. So you can earn 3 times the points for specific eligible dining and food delivery, 2 times the points for purchases on eligible travel, etc. So these American Express consumers find great value in these other benefits, and they believe that they outweigh the annual fee that they pay. And as a result, they are willing to pay these annual fees in order to gain this platinum card, which provides them with all of these additional benefits. Let's go look back at the revenue statement, so income statement. So like we saw, the discount revenue, which we talked about, the net card fees, they have their service fees and other revenue, some from their process revenues, and their total non-interest revenues at about 11.28 million. So that is wonderful to see, and as you can see, the revenue has been ticking up over time. There are ebbs and flows in terms of consumer habits, whether they're spending a lot on travel and dining, but relatively it is going up year over year, or in this case, quarter over quarter. Now, the interest in income on loans, like we said, they are also acting as the institution who is handling the debt. As a result, they were able to get a larger percentage of that discount rate or that discount revenue, but they also have to loan out the money or the credit in order for these consumers to use their credit cards. So they have interest on loan revenue here. You can see that is ticking up. They have some deposits. They have interest and dividends on investment securities, a nominal amount, and that gives you their total interest income. But now you need to take out the interest expenses associated with that, such as their deposits, long-term debt. Their total interest expense about 1.4, and then you have their total revenues here at about 14.281. Now remember, this is in millions, so that is really great to see. So that's about $14.281 billion of revenue. That is very, very great to see. And then their total revenues have been listed here after you look at their receivables and their provision for credit losses. Now, as most companies and most financial institutions, they have been racking up their total provision for credit losses just as a precautionary measure. The one great thing about American Express, like I said before, their business consumer base or their customers are the more affluent customers. They spend more per transaction and theoretically have a higher income. And as a result, a lot of these provisions for credit losses may or may not come to fruition. I'm hoping that they don't. Same with American Express, but they're being cautious just in case and setting aside an allowance for credit losses. Here we have their expenses. Now, their largest expenses being their credit card member rewards. Remember, like I said, they're acting as an institution here as well, and they are providing these card members with their rewards, which they find great value in, but that is their largest expense. Here we can see some other expenses: business development, marketing, salaries, and their total expenses at $11 billion for the quarter. And resulting, after you take out taxes, their net income is about $1.8 billion per this last quarter. That is very nice to see. And here we have their net income attributable to shareholders. Now, we're going to scroll down and look at their balance sheet. I love this, billion-dollar company, very simple balance sheet. Here we have their cash and cash equivalents. So we have about $41 billion there. Card member receivables. We have some loans in there, investment securities, and other being other receivables. So total assets of about $236 billion. Here we have their customer deposits at $121 billion, short-term borrowings, and long-term debt. Now this is what you want to see in a company that you know is well run. Look at their long-term debt and short-term borrowings. $41 billion. If you add in the short-term borrowings, another $2 billion. It's about $43 billion in long-term debt and short borrowings, and they have basically that much as cash on hand. So if they wanted to, they could essentially wipe out this long-term debt without batting an eye, and they would be just fine. And as you can see, their cash position has been growing without taking on really any more debt. Their debt has stayed relatively the same, while their cash position has been increasing year over year as a result of them keeping that cash from their previous quarters, as a result of them generating more and more net income over each quarter. Now, they have other here. These are other payables. This hasn't really changed much, and it stays pretty consistent as well. It is large balance, but that's very, akin to these other credit card loan numbers and other reserves and their other receivables as well. So that's their balance sheet. A very strong balance sheet for American Express. You can hold them, and don't have to worry about them at night, not being able to pay their debts. They could essentially wipe them all out if they wanted to, but they're keeping that cash on hand and building it up, and we'll take a look at why in the trend analysis. So now that we've gone over their income statement and their balance sheet, we're going to be looking at the trend analysis, and for that, we're going to be looking at Qualtrum. So I utilize Qualtrum to look at my holdings in a graphical representation. It's a lot easier for me to look at it that way. I do like reading financial statements, but looking at them in a graph is actually kind of fun, and it keeps me interested in analyzing these specific companies. So we're going to be looking at American Express, like I said. It is at a $116 billion, almost $117 billion market cap. Price to earnings here, very fair price to earnings at about 16.5. And their forward price to earnings at about 13.8. So it's very reasonably valued, in my opinion, for the quality of the business. Here we can see some price to book and price to sales. These are other metrics in terms of valuation. We see their cash flow yield, free cash flow yield, at about 12.5%. Their profit margin, so not as high of a profit margin as we saw with Visa in my previous video at about 50%, but their profit margin is at about 13.9%. And this is because they are acting as all of the parties, like we said, in the transaction. They are not just the payment processing network, they are also the issuer and the merchant, which comes along with additional expenses. But as a result, they're able to control the entire transaction. Here we can see, like we said, the snippet of their cash and debt, essentially, break even here. It's nil. They can pay off this debt whenever they wanted. And like we saw, they're generating about almost $2 billion of net income, which if you equate that to cash flow, it's about $8 billion a year. So they could wipe out anything and wipe out this debt and then be cash positive very, very quickly. So look at their dividend. I bought them as a dividend growth company. Dividend yield 1.53 is respectable. Nothing to be super hyped about. It's not yielding a 4, 5, 6% yield as some other companies may yield, or other mature companies, but the dividend yield is respectable at 1.53%, and the payout ratio, which I like to see, is at 22.7%. So that is actually a great positive. They have a lot of room to grow that dividend over time, and they can continue growing that dividend without a fear of being limited by that dividend in terms of cash flow and operations. They're only paying out 22%, and I like my companies that I hold to have a payout ratio of 60% or lower, as I have a very long investment time horizon. So let's go and look at their revenue. Revenue has been growing at a respectable rate over the past 10 years at about 5.29%. You can see we had these big bumps like in 2022 when everybody got out of COVID. They all wanted to go outside, travel. They were spending on their Amex cards, booking flights, booking entertainment, booking dining experiences. So in the past 2021 and 22 years, you can see that they were very high revenue growth. I expect that to normalize and return to this kind of 5.29% per year revenue growth. Let's look at their earnings before interest, tax, and depreciation. So again, growing very steadily at about 3.75% per year over the past 10 years. Nothing very explosive growth here. It's just more slow and steady wins their ways at about 3.75% per year. Now let's look at their free cash flow. So the free cash flow is where they shine. They generate a lot of free cash flow. They average about 12.29% per year over the past 10 years, with the higher years being these post-COVID years. So the free cash flow per share, I would expect that to be relatively the same. Yep, even higher at 17.03% per year over the past 10 years. Now, because it's growing at a higher rate than their cash flow, I would assume that they're buying back shares, which we can look at in a minute. And the same when you take their adjusted free cash flow, which is good. It tells me they're not adjusting for anything significant, or they're not making any large adjustments to their free cash flow per share. Net income is growing at a respectable 5.30% per year over the past 10 years. Earnings per share, again, this should be higher because they're buying back shares, as I would like to assume. They're 9.69% per year over the past 10 years. Let's go and look at their shares outstanding. Yep, they are buying back shares at a very aggressive rate, at about 4% per year over the past 10 years. So they are taking shares out of the equation, buying them back, canceling them, thereby making your ownership percentage as a shareholder much larger every year. That is great to see. And they are not taking on additional debt to do that. Like we saw, their cash and debt balance, here is relatively similar over the past years. They had some down years here where they had a lot more debt, but it seems like they've accumulated cash. And like we saw, right now they are basically in a cash neutral position, and they could pay off this debt whenever they wanted to. Dividends, I bought this as a dividend growth company, and they are growing dividends very, very strongly each year. It's averaged at about 11% per year over the past 10 years. We can see in most recent years, they had some higher percentage dividend increases, but steady and chugging along at 11.6% per year over the past 10 years. This is going to make my yield on my initial cost that much greater. That is why I invest in dividend growth companies, because they might not pay a lot of dividends out right now, but the performance of me holding them and my yield on cost is going to increase every year that they increase their dividends. And by American Express having a low payout ratio at about 22%, like we discussed, they have ample room to grow this dividend over a long period of time. So that was the trend analysis. Now let's go and look at if you had invested into American Express, what would you have gotten as an average annual return? So I used averageannualreturn.com here, and I did an analysis where I looked at the start date as if you had invested $10,000 as your starting investment into both SPY and into American Express in 1995, and then if you were to hold it until today's date, essentially. So what I learned was that if you held it over this period of time, American Express would have generated you an average annual total return. So this is return with dividends invested of 11.43% compared to SPY, which would have given you about a 9.33% per year. So it's illustrated here in the black graph. This is American Express here, and then this is SPY down here. Now, 11.43% is market beating here. As you can see, we compared it to the market, or in this case, the benchmark being SPY at 9.33% with dividends reinvested. American Express here does outperform the market. Over that same time period, what if we had just taken the dividends as cash, and we just kept our $10,000 in there, but we withdrew the dividends? What would that average annual return look like? So again, American Express does outperform SPY at about 10.48% per year over the past, 20 years, and then 27 years, and then the same, again for SPY is at 8.20%. So again, American Express beating the market, or the benchmark, in this case SPY here, as shown by the black line on the graph and then the blue line on the graph. So American Express, that's been the historical returns. Now again, remember, historical returns are not indicative of future returns, but they can provide a decent basis for us as a starting point and what we could expect. So that was American Express. In closing, I would just like to reiterate some significant points that I thought were worth pointing out, just to summarize here. American Express, they're seen as the top of the line credit card company, the elite credit card company. Sometimes some people or their consumers can see it more as a status symbol for their affluent consumer base. They have a closed loop payment network, which, like we stated before, they obtain a larger percentage of the average spend in a transaction, and they control the entire transaction, as opposed to Visa and MasterCard, which are more the payment processing line, and they get a lower percentage of that transaction, but they do have a larger volume of transactions. American Express has a strong balance sheet. They have a reasonable valuation here, and they are a very well-known company. Have been operating for, I think, 100 something years now. So they have a long history and a long relationship with consumers, and they are seen as a elite company, in my opinion. Now, I'm curious to know what you think about the company, the stock, or any other comments you may have. If I encourage you to leave those comments below, so that I may see them and then I can respond to them. And if you like the video, I encourage you to give me that thumbs up button and subscribe to the channel if you like content like this. And other than that, thank you for listening, and I'll see you in the next video. Please note, I am not a financial advisor by any means. This video was made purely for your entertainment purposes only. Investing is risky, so please do your own due diligence, as I am not liable for any investment decisions you make. Thank you. Have a great day.